It is now my great pleasure to bring on someone who is an idol of mine, who is fantastic at technical analysis because it's what he does for a living. In fact, he founded a company based on it, to take a look at what's happening in the markets now, to talk about opportunities, and to talk about what he sees overall in terms of trend. So let's bring on JC Parets of All Star Charts.
All right. What's up, Neal?
What's up, man? How are you doing?
Good.
I got to be honest. I was talking a big game, but I got a little bit shook as I started looking at these charts, man.
Which charts? What are we shook about? Let's discuss.
It's these Kathy Woods ETFs, man.
Yeah.
Kathy Woods. I'm susceptible, it's the psychology of trading. I am susceptible to getting a little bit shook when I see myself in the red. And I'm hoping that you can put things in context. I'm looking for some technical therapy right now.
Yeah, I mean, listen, we're seeing sector rotation at its finest. Sector rotation is the lifeblood of any bull market. And you look at some long-term laggards turning into leaders. You saw leaders turning into laggards. Look at small caps getting crushed, micro caps getting crushed. These things are monsters. But you know what weren't monsters? Energy, industrials, financials, even European banks making new highs. So it's really a function of sector rotation. It's the lifeblood of a bull market. You're seeing it right in front of you.
Well said. And I know that the last time you were on, you were talking a lot about energy, and it seems that we're seeing that continue to manifest.
Yep. Chevron, we love it. ExxonMobil, we love it. We've been super long. Crude oil. We just took half off the table in on the options trade. We have calls now. It's a free lunch, right? Because when our options premiums double, which they did pretty quickly in crude oil, now we have until next January. So now we have literally a free option that can go to the moon. It can go to zero. We don't lose anything. It's really a great place to be. And the discipline of taking half off the table. It frees your mind, helps you sleep at night. It helps you stay in it longer. All of those things, I encourage it. We're very disciplined when it comes particularly to options. But yeah, we're seeing it. Energy. Warren Buffett is YOLOing Chevron, right? So, I mean, there's a lot of big money flowing into this energy. I think that the commodity super cycle has begun. I've been saying that. We continue to see evidence. Base metals keep ripping. Energy continues to do well. The agricultural commodities, I think the commodity super cycle is upon us. You expect to see people complaining about their gas prices rising. Mm-hmm. You can choose to do that and be one of those people that just complains about high energy costs, or you can be one of the people that are celebrating it. This is America. We have the ability to invest and take advantage of higher energy costs while people are busy complaining about it. We're happy about it. We're rooting it on. The higher the energy prices, the better.
So for folks that are looking at potentially entering the energy stocks purely from trading stocks, what types of things should they be looking for in the charts?
Look at the Nifty Energy Index. India has been a tremendous leading indicator in the bank space, in energy. Look at Nifty Energy breaking out of a multi-year base. Setups are rarely this clean. Look at Chevron. Look at ExxonMobil in particular. I'll give you the exact levels on Chevron.
Do you want me to share my screen? I can pull it up on the chart.
If Chevron is above 96, we want to be long with a target of 123. And if Exxon's above 50, we want to be long with a price target of 66.
Well, let's take a look. I'm going to share my screen. I've got the charts. Let's do one of these. Let's go full.
Yeah, look at that base. Look at that beautiful double bottom, Kardashian bottom. Call it whatever you want. It's a bearish to bullish reversal. Energy has been the worst place on earth. Energy has been worse than bonds, worse than gold, worse than banks. There's nothing worse than energy. Energy can double from here and still needs to rally like another 10, 15% just to get back to former highs. Like, that's how bad energy is. But everybody knows that already. It ain't a secret, right? Just like everybody discovered that Kathy Wood's a badass. Well, now you're paying for discovering it too late. Not you, but like people who have not been on this. People who have not been on this train for a year. Like, where have you been? you should improve your relative strength scans. That's probably what you should do if you're discovering them now, because these things were popping up a long, long time ago. But yeah, energy, if we're, look at Exxon, if we're above those former highs, $50, I think you can own it. And what does that translate into? 30% of upside. That's pretty solid. And on the Chevron, on the CVX, if you want to join Uncle Warren on that train, also looks good. It's a similar trade, right? Obviously, to behemoth energy integrated companies, monsters. And then look at financials. Hello, talk about horrible places to be. Financials have done nothing for 14 years. And people are like, well, JC, financials didn't peak until the summer. Well, Lehman Brothers and Bear Stearns peaked in January and February of 2007, which is the opposite of relative strength. This is relative weakness. So Bear Stearns and Lehman peaking in Q1 of 2007, that was the heads up. Financials peaked that summer. The S&P 500 continued to make new highs into 2007 to October of 07. By then, Lehman and Bear Stearns were already crashing. Financials had already peaked on a relative and absolute basis. Classic. So anyway, it took 14 years to correct that, and now we can move on. 14 years is a long, long time for demand to finally be able to absorb that supply. It did it, got it done. Now we can move on. So the trade's very simple. Mm-hmm. If financials, the XLF, is above those 2007 highs, let's call it 31, we need to be long. And if you're not long, I think it's irresponsible, quite frankly. If we're not above those levels, then we can't make the argument that we've broken out, right? If we're below those 07 highs, then that thesis of a 14-year base breakout is invalidated. So you have a very well-defined risk level, because remember, Neal, it's not about being right. It's about making money, right? So we want to be able to find opportunities where the market, we know what the market needs to do specifically to prove us wrong. And in the case of ExxonMobil, it's break below 50. In the case of Chevron, it's break below 96. In the case of the XLF financials, it's break below 31. JP Morgan, which has been a long, if we're below 141 in JP Morgan, then all bets are off. Here we are making new highs, which we're happy about, of course. So listen, Neal, there's nothing wrong with a market where some stocks are going down and some stocks are going up, right? Mm-hmm. There's nothing wrong with that. I mean, go back in history. Some would actually call that normal.
So with that said, you mentioned folks need to brush up on their market breadth analysis. What is the first step toward doing that? First off, how do you define market breadth? And then what is the first step toward folks being able to do that on their own platforms? Because
remember, people talk about the stock market, like, oh, the stock market, the S&P, the Dow. What did the Dow do today, right? People talk about that stock market like it's a thing. Yeah. But what I think gets forgotten quite often is that it's a market of stocks, right? There's a whole bunch, there's all kinds of sectors, banks and healthcare and, right, energy, technology, consumer discretionary, staples, utilities. There's all kinds of different companies, right? If more of them are going up, then the indexes themselves are probably not going down, right? If most of them are going down, then probably the indexes are going to have a hard time going up. And you can see that deterioration. Like, if you were buying stocks in February of last year, it's because you were ignoring market breadth, right? Market breadth had already peaked way before that. Like, the entire market was deteriorating throughout December and January and into February, well before any coronavirus crash. Like, if you missed that one, I would highly encourage you to reevaluate your process and put processes in place to identify that weakening market breadth, and the opposite, the expansion of market breadth, particularly the breadth thrust that started in June that really started soaring, and then the breadth thrust kept accumulating from there, September, November. Most recently, we got breadth thrust and energy, and now look what's going on. And these breadth thrusts are huge expansions in participation. Percentages of stocks getting overbought that we haven't seen in decades. Last week we saw the most amount of new highs ever, right? That's breadth expansion, not breadth deterioration. So you want to look at it both ways. And the fact that now energy and financials are participating, European banks, emerging markets breaking out a 14-year basis. These are new sectors participating. These are new stocks participating to the upside, not fewer. And the rotation out of some of the big winners and into new winners is classic behavior of bull markets. Classic,
So JC, for people that want to take a look at what's going on in sectors, which sectors are starting to accelerate and starting to meet the whether it's a pattern or whatever, to start to look more attractive and look like there's more of a rotation into them. What are the ETFs that people can look at to cover those different sectors, and they can compare those charts?
Well, remember, it's not just the sectors, it's the countries too. So first thing we want to do is we want to look at every single country in the world, every single one, emerging markets and developed, Asia, Latin America, Europe, right? Every single country on earth priced in local currency. And then we want to do the same thing with all the ETFs priced in US dollars, right? So that's the first thing we're going to do. Then we're going to do the exact same thing for every commodity in the world, right? All the base metals, all the precious metals, energy, agriculture. Where's the strength in commodities? Then we're going to do the same thing in interest rates, all of the interest rates around the world, all of the yield curves, so we see what's going on in the bond market. Then we're going to look at all of the intermarket relationships between all those asset classes around the world. And then we're going to come to the United States, or if we're in India, we're going to go to Indian equities. If we're in Canada, we're going to look at the Canadian equities, depending on the country in question. In this case, let's just call it America, because I know you guys are in beautiful Detroit. And we want to go index by index, S&P 500, Dow, New York Stock Exchange Composite, NASDAQ, small caps, mid caps, micro caps, value line index, every single one, right? Then we're going to go through the sector indexes. Utilities is XLU, healthcare is XLV, staples is XLP, financials, XLF, XLK. Go through the whole slew of them. But what I think gets forgotten is that you have the sector ETFs and the sector indexes that they follow. But underneath that, you have the industry groups. So for example, in healthcare, you've got the XLV. Great. But within healthcare, you have all kinds of different companies. You've got pharmaceuticals. You've got medical equipment. You've got managed health. You've got biotechnology. These industry groups have nothing to do with each other, but they all fall under healthcare. And the truth is, these medical equipment stocks are more technology than they are healthcare, right? You want to look at energy, for example. You have all kinds of different energy companies, oil refiners, explorers and producers, the integrateds. You have so many different kinds. When you talk about financials, you have financials. Berkshire Hathaway is the largest component of financials, which some people don't realize. So within financials, you've got broker-dealers, exchanges, regional banks, insurance stocks, all kinds of different companies. So not just the sectors, but the industry groups too. And then once we decide, hey, we want to buy insurance for whatever reason, hypothetically, it's probably because we like stocks in general, we like US stocks, we like financials, and for whatever reason, insurance stocks are showing relative strength, whatever it is in that scenario. So let's say we decide that we want to own an insurance stock, whatever. I was going to say Chubb. 95% of the reason why we're buying the stock has nothing to do with that chart. It has to do with the other 5,000 charts we looked at that led us there. It just so happens that that particular stock is the best way to express that thesis in the market. But it's not because of some fancy pattern or some lagging indicator crossing over another lagging indicator, like all these moving averages, and you got all these. This is the silliest thing I've ever heard. None of that stuff, right? It's a weight of the evidence, and you have two choices. You can come to All-Star Charts and we do it for you, or every week you go through all 5,000 charts in the world. Every single week, you put on some music, you pour yourself a cup of Joe or a glass of wine, depending on what you're into and what time of the day it is, and you just start ripping through them. And by doing that, there's no way around it, right? There's nothing like putting in the work. I promise you, you could spend all day trying to build a robot to do it for you. Most people do. Most people fail. Pretty much all of them fail. I encourage you, don't build a robot to do it for you. Just do it. Or come to us and we'll do it for you, right? Either one is fine, but you got to put in the work. 5,000 charts a week. There's no way around it, Neal.
Got it. So market breadth by definition is this is just looking at comparing different financial markets and then sectors within those markets, and then seeing divergence and convergence, right? Is that a decent definition?
And then it's all about putting the pieces together, because okay, fine. So why are we looking at all these asset classes? Well, we're seeing the base metal. We've been seeing the base metals breaking out to new highs. Aluminum, zinc, copper, nickel, tin, lead, right? Breaking out to new highs. What else are we seeing? Emerging markets have been outperforming. Doesn't all of that make sense? The base metals have been outperforming the precious metals. Interest, that screams higher interest rates. What have we been seeing? Higher interest rates. What do higher interest rates also suggest? that banks should be doing well. Regional banks should be outperforming. And what's been happening? Regional banks are not performing. Banks are breaking out of multi-decade bases. Like, so the intermarket relationships looking globally confirms or diverges from what we're seeing in the equity markets. You know, for example, when interest rates broke out above 3% in September and October of 2018, the copper gold ratio was rolling over. Regional banks versus REITs were rolling over. They were calling Fugazi on the interest rate breakout, and everyone was like, wow, interest rates are breaking out above 3%. And I'm like, copper's kind of saying no, and regional banks are kind of saying no. We should probably be buying bonds, not selling them, and selling stocks instead. And sure enough, stock market collapsed, bonds ripped. It was a failed breakout in rates. And you would have known that had you gone through all of the other charts, because base metals were saying no, rates are not going higher. Precious metals agreeing, regional banks agreeing. So the bond market was wrong not wrong, but a little over its skis, if you will, in that, right? Because prices are never wrong. But those divergences catch up to one another.
Wait, yeah, JC, can I jump in with a quick question here?
No.
So, okay, never mind.
What's up?
So we've bounced pretty hard here this morning. Also, I mean, we dipped there pretty hard at the open, but we are well off the low of
in what?
The overall S&Ps.
In the S&P 500,
yeah,
okay?
Yeah. Looking at the S&Ps, looking at this balance, it's early yet, but how would you think about that? And how would you approach the S&Ps now? You know, and we had a bit of a shakeout at the open, and we are at least on the SPY. I mean, we are well off that low of the day now, right? So,
yep.
How would you approach this now? Would you see that dip down to 380 on the SPY and say, oh, that was a washout? Or,
well, here's what I think. I think you trade the averages, you're going to get average returns, right? That's how I learned it from a wise Egyptian man. So I would encourage investors to not do that, not day trade indexes. Like, that's like the hardest thing to do in the world. Like, that is so hard. In my opinion, you're much better off owning the relative strength. Like, while people are like worried about like S&Ps and whether it's a washout, financials are breaking out to new highs. Financials are making new all-time highs. JP Morgan, Berkshire Hathaway, XLF, regional banks. So like, I think it's more important to focus on what's working, right? And less on the indexes themselves. And if you're going to focus on an index, I would encourage you to focus on all the indexes, not just isolate the S&P 500 because it's convenient. I would encourage you to look at all of the indexes. And again, not just the US indexes, but globally, the S&P Global Index, the Global Dow, the Euro Stock 600, that's, by the way, breaking out of a 20-year base, the Shanghai Composite in China, Australia breaking out of a 13-year base, Canada finally doing well. Think about what's in Canada. Think about why Canadian stocks and the indexes have sucked for so long. You know why they sucked? And there was such underperformance? Because they got a ton of natural resource exposure and a ton of financial exposure. I think like 50-something% of that index is natural resources and banks. And why is Canada doing so well now? Well, what's doing so well? Energy, financials, like that's got Canada written all over it.
I just added one more thing, Neal, and then I'll go back to being in my hole. But you'd be hard-pressed. JC is a great follow on Twitter at All-Star Charts. You'd be hard-pressed to find somebody that tweets more about like non-mainstream or maybe global indices than JC. JC just mentioned a bunch right there. He's tweeting about these global indices nonstop. He's not tweeting about the S&Ps. God forbid the Dow, right? That's like the curse word. No.
I love the Dow. I'm not hating on the Dow. I'm not hating on the Dow or the S&P.
No. I'm saying, but you pay attention to like everything. You do not everything. You're talking about European indices, the emerging market indices, stuff that a lot of people just ignore because the U.S. has been so freaking awesome for the last decade, and you don't.
Yeah, but guess what? Guess what happened the prior decade?
Well, I know that. I'm saying
when I first got in this business, emerging markets, commodities, that was the place to be. If you weren't in those things, you were losing, right? When I first got in this business, think about this. My first 4 years of my career from 03 to 07, emerging markets went up on average 100% per year. Literally a 100% return on average per year in my first 4 years of my career. And then everything fell apart after that. But now we're back. Neal, Spencer, I'm telling you guys, I think this commodity super cycle is in play, baby. Inflation. Look at 5-year forwards. They're pricing in inflation. Why are interest rates going up? Why are bonds getting slammed? Why are base metals outperforming precious metals? Inflation, 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 baby. Let's go.
Got it. All right. So I hear you. There's one name that I'm interested right now. OXY. You tweeted there's a rumor going around that they might be issuing warrants.
No, they did.
They did issue it.
They issued them last year.
Oh yeah. So last year. Okay. So are you thinking what does that mean to us? What does that mean to us? We see these going up. Warrants are a company basically giving you a call option, basically saying you can buy these warrants so that we can get an injection of cash right now. And if you decide to exercise it, you can get shares of our company at a price, like a previous low, ideally. That's why warrants are really cool, right? So and I imagine they can be traded. I've never owned
right.
a warrant.
Well, that's the point. We're not exercising anything.
Okay. So you're just trading the warrants. You're trading the contract.
It's like an option. You're not actually going to you're not going to take physical delivery of the crude oil barrels, right? Or the live cattle. You know what I'm saying? Like in my New York City apartment, stick with cattle in there, right? Like that's not actually happening. You're just trading the contract. Same thing with the warrants. And basically, just to keep it simple, stupid. Why is JC bringing up the Oxy warrants? Well, I'm incredibly fortunate that I get to talk to a lot of smart folks like every day of my life, whether on a podcast or whether just our own internal meetings. Like our team is full of really smart people, as you guys know, Straza and Rashmi, Ayush and Willie. I mean, just off the charts in terms of intelligence. So just in my own firm, I have brilliant conversations and great perspective as well with our clients. These are monster portfolio managers. These are household names. Obviously I can't mention who they are, but you know who they are. These are the biggest banks. These are the biggest hedge funds on planet Earth. So when I like something, they're like, JC, how much do you like it? And I'm like, well, probably not as much as you're about to buy. But the bottom line is I hear things. Maybe for whatever reason, weren't on our radar. It happens every day. We even joke about it. Like I always message Straz on Slack. I was like, dude, look at the stock that so-and-so just sent over. And he just laughs. He's like, wow, how did we not catch that one? It's almost like a game we play. So what's the chatter? Oxy warrants. So this is, just to put it simply, this is the riskiest way to take advantage of higher energy stocks. So it's going to give you, outside of options, right? I guess you can own out of the money calls or whatever. And we do. But if you don't want to worry about that decay that Neal was just talking about before I got here, that theta and gamma decay and whatnot, Oxy, if it's above 25, I think you can own Oxy. I think Oxy can double from here. This is Oxy Petroleum. OXY. And if you really want to get gangster and you want to be in the warrants, just understand that's going to come with some serious beta, right? These things move.
Too complex for me.
These things move, but it's very simple. You own Oxy if it's above 25. If it's not above 25, you don't own Oxy. You don't own the warrants. You have nothing to do with Oxy. But if we're above 25, I think you can own either one. Own the stock, and if you want to own the warrants, again, only if Oxy is above 25, and just understand that you're going to get some juice. You're going to get serious juice. And I know a lot of investors out there are looking for the juice. So the warrants give you that.
Got it. All right. So that was not a new rumor. That was something that happened previously. And you have the opportunity to grab those. Risky, but with inflation, we are going into a commodities uptick. Commodities are in an upward trend now in response to rotation. We're hearing that from JC Parets. That is probably what was baked into the charts when we were looking at those double bottoms that were pretty consistent across XOM, OXY. What was the other one? There was one that started with an VET, VET, in these energy tickers. They had some nice gap downs. They hit the bottom, and then they closed those gaps. And
I like that VET. I didn't know this one. VET. See, this is a good example of me talking to smart folks. Right?
You like one of my picks, JC?
I do like it. Well, I mean, I like the whole space. So, I mean, I probably like, All
right.
Right. So this is VET. It's a tiny one. It's a small cap. It's less than $1 billion. So talk about juice. This has plenty of juice already baked in.
Okay, cool. So that was. I feel like my dad just said he was proud of me. That was a great moment for me, JC. Thank you so much for coming onto the show on such short notice to talk about what's happening with market breadth, rotation into commodities, still a theme. You said it a few weeks ago, and it's coming in strong today. JC Parets from All Star Charts. I mentioned you're at All Star Charts, but JC, where can folks, that they want to hear more from you and they want to continue getting some of the knowledge that you have to share, what you're looking at, where can they do that?
So I'll be at the local bar down the block. You can buy me a beer. No, go to allstarcharts.com. I'm easy to find, allstarcharts.com. And then on the social media interwebs, I'm at All Star Charts on Twitter, Instagram, StockTwits, and YouTube. I'm easy to find. So just shoot me a note, say what's up. If you're interested, I'll send you our most recent report. Our Under the Hood report just dropped. Our 2 to 100 club drops today. So the Under the Hood report are stocks that are showing an unusual increase in investor interest. A lot of banks and energy stocks popping up. So they get on our radar, and then we hand select the best opportunities on the long side and the short side. The 2 to 100 club drops tonight. So these are the stocks that we think are the next $100 billion companies. I'll leave you with one. Check out Real, REAL. This is, my sister works there. Specialty realtor. It's about $2.6 billion. I think it goes to $4 billion. If the stock's above 30, we want to be long. If it's below 30, leave it alone. Too much opportunity cost, too much downside risk. But if we're above 30, I like this baby long. I think you got 50% of upside. I think it's a $4 billion stock coming.
Added that to the watch list, JC. Thank you very much, my friend. You have a wonderful
Got
day.
it. Set those alerts at 30 and a couple of pennies. Buy it on the way up. That's what we're gonna do.
All right, man. Will do. All right, take care, JC.
All right, guys. Adios.